Now in this morning's U.S. Bank Economic 360, we're talking about the so-called Great Rotation. That is, the Great Rotation of assets leaving bond investments and going into stock investments. It's been long anticipated and much hype, but so far has proven to be only mythical. Mike Denneman, Vice President and Senior Portfolio Manager at U.S. Bank, joins us this morning with more. Mike, good morning.
Good morning, Brian.
Good to have you with us. So since the economic crisis of 2008, individual investors seem to have favored bonds over stocks. Kind of give us an idea of where that's playing out.
Sure. Well, and that's only natural, of course. When economic difficulties arise, investors tend to gravitate towards safe investments rather than risky ones. But that's typically a short-term phenomenon. As the crisis fades, investors will leave bonds and move back into stocks, the so-called Great Rotation, as you mentioned. But what's unique here is that we're almost 5 years past the crisis, and investors are still favoring bonds over stocks. And when you put that in context of A, the stock market being on a great run, and B, bond investments paying very low yields, you would think that investors would have every incentive to ditch bonds and move into stocks. So the fact that that hasn't happened yet, I think, pretty well outlines the mindset of the average investor, which is to avoid risk and continue to embrace conservative, safe investments.
That's very strange, and you wonder how much money people didn't make by not going into bonds during this big spike in the market. Is this a big deal for the stock market?
It could be. I mean, if you think about if the rotation were to happen, just the sheer size, the billions of dollars that would move from bonds to stocks would, just through the law of supply and demand, push the stock market higher. So you see a lot of market pundits claiming that this would be a great, maybe second wind even for the stock market, and count this rotation, if it were to happen, as just one more reason to be bullish on stocks.
Well, they say to buy low and sell high, so it's been high. Maybe that's why people are avoiding buying. What have we seen in this area recently? Is the rotation increasing at all?
Well, we got a bit of a hint of a rotation a couple months ago when Ben Bernanke started talking about higher interest rates. That spooked some bond investors, and we saw money flowing out of bonds. But it didn't take that next step and move into stocks. It went into cash or into money market funds. So we got almost a half rotation, if you will. And since then, we've seen that money moving again, but in fact back into bonds rather than into stocks. So that really calls into question whether or not the so-called Great Rotation is even on the horizon. And it may be a more permanent situation than we think. Investors sticking with bonds because they simply don't want to take on the risk that's represented by the stock market.
So this idea of Great Rotation, have we seen that before in the cycle of the markets, or is this something relatively new?
It's not new. It happens every time we have a large recession or a financial crisis. But it's, you know, each one is different, each one is unique, and I think the severity of the financial crisis of 2008 has a lot to do with this reluctance by individual investors to re-embrace the stock market.
So do you think this is the end of the Great Rotation, that it's pretty much passé now?
You never know.
You never know. You gonna watch it for us?
I will.
I appreciate it. We appreciate you, Mike, and U.S. Bank. Thank you.
Thank you.